All right, good morning, everyone. Again, can we please join me in a round of applause for our wonderful sponsors without whom today's event would not be possible. Thank you. I think we can do better than that. A little more applause, louder. There we go. Just pretend you're at the Razorbacks basketball game and we just beat LSU at the last minute. All right, there we go. That's what we're looking for. All right, can you please help me welcome the Chancellor, Dr. Charles Robinson, to the stage to address all of us and give us a word of welcome. Thank you.
Hey, good afternoon and welcome, everyone. So happy that you could be here. This is a wonderful annual event. And as you can see, it attracts a lot of us to come and hear a top-notch program and forecast that help us to prepare for the coming year. You know, I was thinking about, and before I get into those comments, let me do this, because I've got some housekeeping. We've got some people here we need to recognize. The President of the Pro Tem of the Senate, Mr. Bart Hester, is here. Can you wave your hand, stand up? Mr. Hester, there you go. Then we've got our Secretary of DF&A, Mr. Jim Hudson. He's here, I know, because I shook his hand. There he is. And then we have a number of state, local, county representatives. Would you please stand to show people that you're here and you support this program? We want to recognize you. Please stand. So happy to have such great representation out. The University of Arkansas really appreciates all of its supporters. And we couldn't be the type of university we want to be without each and every one of you. Now, we've all we're coming out of a snow event. And Northwest Arkansas does a lot of things well. We attract talent. We are a great place for entrepreneurs. We do well with building infrastructure, but the one thing we don't do really well is manage snow events. No, we're not good in snow. And so it's so important for us to prepare for these events before they actually hit us. And we did a lot of planning at the University of Arkansas. And what was crucial to us was the forecast, because the forecast helps you to make the right decisions, to have a sense of how long, how intense, and what you might do to better engage the reality of what's about to hit you. And I think that's a great analogy for why we're here. This economic forecast helps us to be better prepared. Now, we don't hope for or expect a storm, an economic storm, but we want to be best prepared for whatever is coming our way so that we can enhance our opportunity in our various businesses. So again, on behalf of the University of Arkansas, we're so grateful for you to support this event, to join us and to be a part of it. And I'm gonna take my seat, but you know, I've gotta say go Hogs, that's mandatory. I'm not gonna make you call the Hogs because you're eating, but I wanna direct your attention to the screen. Thank you so much.
The Sam M. Walton College of Business is in a period of strong growth and momentum, driven by results. Over the past year, we've seen significant growth, rising quality, and increased national recognition. Welcome to the 2026 Arkansas Business Forecast Luncheon. At the Walton College, we measure success by outcomes, by the leaders we develop, and the value they create for Arkansas and the global economy. Today, the Walton College is one of the largest business schools in the United States, serving more than 10,000 students. That growth matters, but what matters more is who those students are. Our focus is on the quality of education we provide, and that quality is reflected in our national standing. The Walton College has ranked among the U.S. News top 30 public business schools for 23 consecutive years. Our graduate entrepreneurship program is ranked in the top 25 by the Princeton Review, and our supply chain program continues to lead the nation at #1, according to Gartner. What distinguishes the Walton College isn't just our location. It's our ability to deliver top-tier business talent from the heartland with the performance and relevance of the nation's best schools. These outcomes are driven by our faculty, whose research advances their fields and directly informs how businesses grow, compete, and innovate. We're also expanding our graduate and executive education offerings to meet evolving industry demand around us. Next month, we will honor 4 new inductees into the Arkansas Business Hall of Fame. Leaders whose careers reflect the enterprise, integrity, and impact that define our state. Business schools don't compete on reputation alone. They compete on results, relevance, and trust, which is built through strong partnerships with the business community, engaged alumni, and stakeholders across Arkansas and beyond. We're proud to host the Arkansas Business Forecast Luncheon. Get ready for the look ahead with insights you'll carry throughout 2026.
Welcome. My name is Brent Williams, Dean of the Sam M. Walton College, and I could not be more pleased to reiterate my welcome to you and thank you for spending a couple of hours with us to learn about the predictions for 2026. You're in for a treat today. You're going to enjoy it, and I know there'll be some key takeaways for you. Well, like we always do at the Business Forecast Luncheon, we always invite you to forecast 15 economic indicators for the upcoming year. Then, we give awards to our top overall forecasters. If you've been here before, I'm sure you recall. I would now like to announce who among you were the most accurate economic forecasters in 2025. Mervin is going to join me at the stage to help present the awards. As I call your name, please come up and receive your award. First, the best Dow Jones Industrial Average forecaster, and then I'll turn to the overall contest winners. The Dan B. Grubb Award for the best Dow Jones forecast goes to Jared Gabriel. Jared is with Central Bank. Jared? Let's congratulate Jared. I'll now announce the 3 best overall economic forecasters from last year. Our 3rd place forecaster for 2025 is Jamie Henry. Jamie is Vice President with Walmart. Our 2nd place forecaster is Mark Cloud with First National Bank of Northwest Arkansas. And now, the top spot, which we named the Marianne Greenwood Award for the best economic forecast. Chancellor, I think you're gonna like this one. It goes to Ann Bordelon. Ann is the Executive Vice Chancellor for Finance and Administration at the University of Arkansas. Beyond being just a great forecaster and a great CFO for the university, she's also a great teacher. We co-teach a class called Leadership Lessons Learned every fall. So, Ann, congratulations. Let me once again remind you, if you will, please fill out this year's contest form, which is available on the blue sheet on your table. We also have a QR code if you want to fill it out online. And please make sure to forecast all 15 variables to be eligible for the awards. Finally, please make sure to fill out contact information, including your email address and the event evaluation. And now, it's my pleasure to introduce Mervyn Jebaraj. Mervyn is the director of the Center for Business and Economic Research. As you know, he is an exceptional source of business and economic related expertise that journalists, business people, and those throughout our state rely on. His work is regularly noted in the state's business media, such as Arkansas Business and the Northwest Arkansas Business Journal, and he's been recognized in their top 40 under 40 lists. Mervyn serves on the Urban Land Institute of Northwest Arkansas and the Arkansas Advocates for Families and Children Board. Please welcome our own Mervyn Jebaraj.
Well, good morning, everyone, again. Now that I've finished haranguing you to take your seats and get into your food, I can throw some economics at you and see how you feel about all of that. So we're going to do a little bit unusual today. I'm going to talk about the Arkansas economy and the local economy, but I'm also going to talk about the global economy here. I find I can hear myself so well that I can't hear the rest of my thoughts, but that's okay. So we'll start with where we are here in Northwest Arkansas, where the news is always good. In the last year, between 2024 and 2025, we added about 11,000 jobs here in Northwest Arkansas. Has been a great year for job growth here in Northwest Arkansas. Our growth rate was about 3.5%. And then if you try to figure out where all these jobs came from, just look around yourselves at your fellow table guests. Some of you might be new to the region. That's where a lot of the job growth came from, in the professional business services sector, where a lot of you are represented here today. So we added about 4,000, a little over 4,000 jobs in the professional business services sector. That has been, for a long time, our fastest growing sector in terms of job growth here in Northwest Arkansas. The other sector that did well in Northwest Arkansas was the leisure and hospitality sector. So we've added a lot of jobs in restaurants, in hotels. If you think back to how things were in Northwest Arkansas 10, 15 years ago, we didn't really have that many hotel rooms. We have a lot of hotels. And then when we did have hotel rooms, we didn't have a lot of nice hotels. We all of a sudden have a lot of hotel rooms and a lot of nice hotel rooms as well. So that has helped a lot. And then some of the other job growth, we've added about 1,300 to about 1,500 jobs in healthcare sector, in the trade, transportation, utility sector. A lot of that was in retail trade. So clearly a lot of you have been going out and shopping in the last year. And then we added about 1,500 jobs on average in state government in the last year. So we lost some jobs from the federal government. We didn't add a whole lot of jobs in local government, but we added on average about 1,500 jobs in state government in the last year. I know people in the past have joked about moving the state capital from Little Rock to Northwest Arkansas. We only added about 400 state government jobs in Little Rock and added 1,500 here. So someone's doing it covertly without telling anybody else. By the way, this is a joke. I do not endorse moving the state capital. I want to make that very clear to everybody here. I do not endorse moving the state capital here. But apparently if you move all the jobs, that's just as well. So let's start with my forecast for what Northwest Arkansas is going to look like in 2026. My usual caveat here about forecasting. Forecasting, unlike what many people might say, economic forecasting is not like weather forecasting, okay? It's simply not the same. Weather forecasters, as we saw in the last week, are wrong in feet and inches, okay? They said 15 inches of snow or something last week. We didn't get 15 inches. When I'm wrong on my forecast on this slide, it's just millimeters. You won't even be able to see the difference here on that slide, okay? So big difference, feet and inches, millimeters. We don't even use millimeters here. But my forecast for Northwest Arkansas is about 9,000 jobs, a little over 9,000 jobs to be added. So yes, the growth rate is a little slower than 2025, but we expect growth in the same sectors that we saw job growth in 2025. So we expect to see continued job growth in professional business services. So those are your lawyers, accountants, people at corporate headquarters, all the people that work with the people at corporate headquarters. That's where we continue to see job growth. That's where we expect to see job growth. We expect to see additional job growth in the leisure and hospitality industry. It's not just people visiting Northwest Arkansas, but it's all of you doing DoorDash orders as well. All that counts towards the leisure and hospitality industry, and all of you doing a lot of that, especially in the last week when you didn't really want to leave the house. But along with that, we expect continued growth in the healthcare sector like we did in the last year, and maybe modest growth in the local government sector as well, as we need to find more teachers to teach all our children here. And then this looks at our population growth rate for Northwest Arkansas in the last several years. I went all the way back to 2018, 2019, just to give you some added perspective here. But you can see in the last decade, our average growth rate was between 10 and 12,000 each year. This decade, it has consistently been between 13 and 14,000 people each year. The most recent data that we have, we'll get new data in March, is about 13,700 people. About 10,500 of those are people moving in. The rest of it is the difference between births and deaths. So about 10,400 people is people moving in. I'm not gonna ask you to do math this early on a Friday, but 10,400 divided by 365 is roughly a little over 28 people a day. So that's how many people net new are coming into Northwest Arkansas each day in the last year. Do I expect that growth rate to remain as high in the upcoming year? Probably come down a little bit. So we did get information on how much our state grew in the last year. So previous years, our state was growing by about 24,000 people each year. We were about 13,700. In most recent data that we have for 24-25, the state grew about 19,000 people, net new people coming in. The overall population growth was a little bit under that because the natural births versus deaths decreased a little bit. So again, if we're gonna grow at 13,000, we're gonna be most of the growth. That's traditionally not been how it is, so I would expect our growth rate to come back to the lower end of the range that we've been in the last year. All that said, you guys probably saw in the news over the last several days, there was the Milken report that announced the top metro areas or top cities, best performing cities in the country. And who was number one? This is the participation part. You get extra credit here at some point. Maybe I'll give you an extra slice of dessert. Who was number one? Anyone? I know people don't really read the newspaper, but it was in the newspaper. We were number one, right? Northwest Arkansas was listed as there. Graham, you got some chant going? Yeah, is there an NWA chant that I don't know about? No, it's not worth doing publicly. Okay, all right. So Northwest Arkansas was listed as the best performing region nationwide. We're up there with some of the peer regions we compare ourselves to as Austin, Texas, Provo-Orem as well. So we outperformed all of them in the last year, at least in this ranking. So that's great news, and part of the reason was because we had great job growth, as I showed you in the previous chart. We had great wage growth as well, as I showed you. And the one thing that irked me a little is that they said we're affordable. So they said one of the reasons our ranking was so high was that we're affordable, which is true if you compare ourselves to Austin or Provo or some of those other places. But now that they've told everybody that Northwest Arkansas is a great place and it's affordable, if you think that population growth that we've been having has been pretty high, you're going to encourage more people to try to look at Northwest Arkansas. So we do have some work while we are more affordable than some of those other regions. We do have some work to do in trying to improve overall housing affordability for the people that are already here in Northwest Arkansas. So this chart gives you an idea of what the home sales look like in Northwest Arkansas over the last year. We had a little over 10,000 sales in the last year, which was very similar to what we had in 2024. So in spite of the gyrations in the mortgage rate over the last couple of years, the home sales has remained fairly consistent in 2024 and 2025. And if you're looking at this chart, it is still better than 2018 home sales. It's better than 2019 home sales. It's better than 2022, and it's better than 2023. The only 2 years it did not outperform were 2020 and 2021, and we're very unlikely to hit those numbers unless the population really grows much larger, because those were years when the mortgage rate was really, really low, and we're not likely to see that anytime soon. Or maybe we don't want to see that either anytime soon. But then this gives you an idea of home price increases in the last several years as well. So compared to other major metro areas, other parts of our country, you can see home prices in Northwest Arkansas continued to go up in the last year. So some of the other major metro markets had seen some flattening, some reductions. But here in Northwest Arkansas, you can see the home prices continue to climb. Now, the rate of growth has slowed somewhat, but the home prices are still climbing here in Northwest Arkansas, so that's something to keep in mind. So one thing to keep in mind when they announced, the Milken Institute said that we're a lot more affordable, one of the metrics they were looking at was to see how much our wage growth compares with home price increases. And so it is true in the last couple of years, our wage growth has been really strong. So if you compare our median wage growth to the median home price in Northwest Arkansas, that line, instead of moving up, has been flat, so we've not made it any worse. That's good news. But it's not getting better in terms of overall affordability yet. But the first step towards getting better is to not make it worse, so I guess we're at least on that rung of the ladder. So we have a lot of work as a region still left to do to improve housing affordability here in Northwest Arkansas. And that's, as I said, home prices are going up. As various people always point out, home prices going up are great for people that already own their houses. If you don't own one, I guess it's what we call in the South character building. So one of the ways we're dealing with home price increases has been to try to improve the regulatory regime in our cities to make it easier to build homes. So major cities, Rogers, for example, where we are, has improved their zoning regulations. Bentonville is working on a similar plan. Fayetteville did it on College Avenue. But in addition to doing all of these things, we have other barriers, and a lot of that has to do with infrastructure here in Northwest Arkansas. So in the previous decade, a lot of our population growth was accommodated by small cities in Northwest Arkansas that had cheaper land, cheaper housing, and a lot of available water and sewer infrastructure. That has pretty much ended for the most part. Our smaller cities have reached the limits of their water and sewer infrastructure, whereas the larger cities have also run into some limits for water and sewer infrastructure. The difference being that larger cities have more sales tax capacity to pay for new investments in water and sewer infrastructure. So the way we think about this is that in the future, so in the last decade, the smaller cities picked up most of the growth. In this decade and the upcoming decade, the bigger cities are going to have to pick up most of the population growth, more so than we saw in the last decade. And the way they're going to have to do that is by continuing to invest in water and sewer infrastructure, which is what I put a picture of. Nobody really wants to see where your business goes at the end of the day. But then I have to look at your social media feeds on a regular basis, so I guess it's fair play. I've seen experts on snow removal in the last week. Last month, it was experts on Krampus in Fayetteville. That's an inside joke that only Fayetteville people know. I'm sorry to bring that up again. But the city of Bentonville is investing about over $200 million in improving water and sewer infrastructure. That passed very recently In the city of Fayetteville, we have a bond initiative coming up in March where Fayetteville residents can vote to improve water and sewer infrastructure. So this is my plea to you that if you live in the city of Fayetteville, quit complaining about Krampus and go vote in the March election for new water and sewer infrastructure in the city. Oh, thank you. I got claps for that. That must be the city of Fayetteville table there. Let's talk about the central region in Arkansas. This has been an area where we had stable growth over the last several years. So the previous year, you can see the previous time period, we had about 6,000 jobs grown in central Arkansas, and now we have about 4,000 jobs increase in central Arkansas. A lot of these jobs came in exactly two sectors, healthcare and leisure and hospitality. So again, a lot of restaurants, hotels, those types of jobs, and a lot of jobs in the healthcare sector, which obviously Central Arkansas has the largest healthcare industry in the rest of our state. And so when we look at some other regions around our state, in Fort Smith, again, very modest job growth in the last couple of years. In the last year, most of that growth came, again, from leisure and hospitality and healthcare, very similar to Central Arkansas, a little bit from professional business services. So Fort Smith has yet to see the impacts of the new military mission training fighter pilots who fly F-35s and F-16s, if I remember correctly, from other countries. That has seen some delays, but I think the first pilots from Finland are here in Fort Smith, so we should have about 100 Finns in Fort Smith in the next year. I'm told that Finns like reindeer meat, and we have a feral urban deer problem around northwest Arkansas. So I don't know how it works to strafe these deer from the air, but if someone can work that out, we could get a real good urban deer problem taken care of. Again, you shouldn't listen to me about these things. I clearly should not be trusted with a mic most of the time. Jonesboro, our other growing region in the state of Arkansas, we had about 900 jobs in the last year. In the previous year, it was about 1,100 jobs. Most of these jobs, again, came from the service sector, not a whole lot of increases in the manufacturing sector. But broadly, in northeast Arkansas, outside the Jonesboro MSA, that's where we see growth in the manufacturing sectors, specifically our steel industry and all their suppliers that are in and around Mississippi County. But unlike previous bouts where we see a lot of industrial production in our state, we haven't seen a significant increase in jobs. We haven't seen some increase in jobs in the steel manufacturing sector, not a significant increase in jobs. And the primary challenge for the steel industry and the people working in the steel industry is that we're unable to keep the people working in the steel industry in Mississippi County. Some of them commute from other counties, some of them commute from other states as well. In previous eras, when you have large industrial developments, those industries typically invest in the hospital system and the school system and all of the other amenities that make a place great to live. But margins are really tight in most industries, especially in manufacturing industries these years. So you don't see a whole lot of investment from them in schools, or they're not able to spend as much money on schools and amenities and things of that nature that we've invested here in Northwest Arkansas, for example. So those types of manufacturing industries don't have that excess cash to spend on amenities like we do here in Northwest Arkansas. So it becomes harder to try to get, so even though we have a lot of jobs in manufacturing there, it becomes harder to get them to be state residents. So that remains a challenge in Northeast Arkansas. So, and then finally, we have Hot Springs. Again, this is mostly our tourism economy here, but you can see there's been some steady decline in jobs in the Hot Springs market. So yes, there's been a lot of investments in hospitality, especially around the casino there, and a lot of new developments downtown, but we've yet to see that pan out in additional job growth. So Hot Springs saw some job losses in both manufacturing sector and the services sector as well. And then this chart, it's coming up here, gives you an idea of how all of these metro areas have done compared to the recession that we had in 2007. So that dotted black line is the mark where most of that employment was in 2007. And so you can see that most of our metro areas are doing better than they were in 2007. But Fort Smith and Pine Bluff in particular have not done well compared to where they were in 2007. So most of our metro areas broadly recovered from the recession-based pandemic, but you can still see that Northwest Arkansas, Jonesboro did a lot better compared to 2007, but some of our other metros are just barely better than where they were in 2007. And then we look at our unemployment rates in our metro areas here. We're at 3.2%, so we were in the low 2% in Northwest Arkansas last year, but now we're about 3.2%. And then you're looking at the other unemployment rates in our metro areas. You can see all the rest of them are above 4%. And then finally, you look at that line at the top there, that's Pine Bluff, and it looks like it's cut off. Pine Bluff lost enough population in the metropolitan area that they stopped being a metropolitan statistical area, so we no longer get monthly information for Pine Bluff. We'll only get annual information on a delayed time basis. And then to talk about the state as a whole, you can see our unemployment rate is pretty close to the national average right now. So this national unemployment rate is about 4.4%. For the most recent data that we have, state and national data. And then the state's unemployment rate is up to 4.2%, so we're no longer in those low 3%. And we also closed the gap between the national and state unemployment rates. What to keep in mind, though, is that wages are still growing in the state of Arkansas. This has helped the labor force participation rate. So even though the unemployment rate has gone up, the unemployment rate has gone up because more people are entering the labor force. A lot of people are finding work, but the number of people unemployed has also gone up. But in part, we're seeing this growth in our labor force in Arkansas because wages are still growing above 4%. Headline inflation rate is still under or about 3% or under 3%, so we're still growing our wages a little faster than the rate of inflation. So that is encouraging more people to enter the workforce. Nonetheless, our overall labor force participation rate is still fairly low at 59%, but it has steadily increased over the last couple of years. So that brings me to talk about non-farm employment for the state as a whole. Again, in Arkansas, non-farm employment is basically everybody we know except the people growing our food. So this is what that is. Here, we grew about 16,000 jobs in the last year compared to 19,000 jobs in the year before. I fully expect there are going to be revisions coming out in April. I expect this number to be lower than 15,000 jobs that we see on this headline here. But we've had fairly strong job growth in our state in the last several years, especially since the pandemic. And I know this line is a little bit hard to read since we're dealing in millimeters, not feet and inches here. But you can see that from 2007 to where we are today, we've added roughly 200,000 jobs. Half of that job growth came since 2020. So between 2007 and 2020, we added close to 100,000 jobs. And then in the last 5 years, we added the remaining 100,000 jobs. So most of that job growth, that fast job growth, has happened in the last 5 years here in the state of Arkansas. And that's true for the rest of the nation as well. Post-COVID economy has been fairly strong. And we look at, for the state as a whole, where these jobs are coming from. You can see the leisure and hospitality industry there leads at the top with a little over 6,000 jobs. A third of those jobs were in central Arkansas, and a third of those jobs were in northwest Arkansas. Obviously, as a state, we've made a lot of investments in our outdoor economy and trying to get all of these different amenities for people to come spend their time here in the state of Arkansas. I know what we've done in northwest Arkansas has helped a lot as well. So northwest Arkansas used to be a business traveler place. People would come in, take those morning flights in, and take the evening flight out without spending any time in northwest Arkansas. Now we have enough amenities to convince them to at least stay a night, if not more, in northwest Arkansas. That has certainly helped. Now, if you're into mountain biking, you're probably going to stay more than one night. So you fly in, you do your business meetings, then you spend the next day mountain biking, and then you spend the next month at Mercy Hospital recovering from all of that. So that's where you see that growth in healthcare. Follows right after leisure and hospitality. You know, we don't care how they come and stay in northwest Arkansas. That's all new money coming in one way or the other. But most of that growth, at least over half of that growth in the healthcare space has come from Central Arkansas. So Northwest Arkansas is not a very big component of that, but we're working on it, I promise. We'll break your bones one way or the other. And then, as I pointed out, in several of our metro areas, you've seen a lot of growth in retail trade. So a lot of employment has grown in that particular sector as well. And then you work your way down, you see a little bit of growth in the manufacturing sector, in both durable goods manufacturing and non-durable goods manufacturing. And then as you work your way through the bottom there, you see decreases in other sectors. So the overall government sector has decreased, largely driven by federal government cuts there. Information services, so some of that is tech services, tech sector jobs have decreased here in the state of Arkansas. And then all the way at the bottom, you see construction. This has been an area where we've seen a lot of growth in the last 5 years, but in the last year, we've seen a decline in the number of jobs in construction. That's entirely because we've finally built the exact right number of car washes in our state. So we no longer need all those people in construction. Good news, though, is that all those car washes are done, but we're not done with data centers. They both use water, so we can just put a data center in every corner like we did car washes, and we can get that construction jobs back. So we do expect construction to pick back up, in large part, a lot of data center construction. But some of the change in construction employment here has been because some of the very large projects that we were building across our state here in Northwest Arkansas have finally completed. And then some of the federal government largesse in infrastructure has largely tapped out as well. So we don't expect continued growth there. And so this is my forecast for the state's employment growth in the next year. So this is what I would call moderate growth, which in economist speak is not bad enough to panic, not great enough to pat your shoulder either. So this is about 13,000 jobs, projected 13,000 jobs in 2026 here in the state of Arkansas. So very quick overview here about our state to try to get you where we might see some growth, where we could invest to see more growth. This is the overall state GDP all the way to the third quarter of last year. I have here the state's GDP and then the state's GDP without the agricultural sector, which is the blue line. So the blue line basically gives you some idea of how our state is growing without the volatility from the ag sector. And you can see that we're generally growing close to about 3% without the volatility from the ag sector. And then you add in the volatility from the ag sector. Some years were close to 6%, some years were negative as well. So the ag sector in Arkansas, as you'd all seen in the news in the last year, has had a very difficult time, in part because some of their export partners were no longer buying their products, but also because they were dealing with some of the impacts of tariffs in the ag sector. So this gives you an idea nationally of how much tariffs affected the ag sector as a whole. This roughly adds up to $1 billion in additional input costs to agriculture because of the tariffs. Luckily, these tariffs were suspended, or these specific tariffs were suspended for the ag sector in November of last year. But nonetheless, projections indicate that the ag sector is not going to do remarkably better in this upcoming year. It's going to be very similar, at least in the state of Arkansas, to how the ag sector performs. So if we're looking towards headline job growth or headline economic growth for the state of Arkansas, it's likely not coming from the ag sector. This is an area where the state has underinvested compared to other states. This is an area where if we continue to invest more money, we could actually see much greater return. So this is showing you research and development as a share of the state's GDP. And you can see how we compare to some of our border states. We're obviously doing better than Louisiana and Mississippi, but we're about half as much as Oklahoma, Missouri, Tennessee, and then a little more than that for Texas as a whole. So if we continue to invest in the research and development sector, we could grow the companies that we already have here in Northwest Arkansas and around the state, but also form new companies that add to job growth, provide economic opportunity for the rest of the state. So this compares the employment in the research and development sector, both public and private, for all those states that I pointed out that are doing better than us, that are our border states. So you can see that on average, they range between having double the number of people working in research and development between public and private sectors to triple or a lot more in the state of Missouri. This is what this employment looks like in the state of Arkansas. you can actually see that our private sector over the last couple of years has added research and development jobs, so that's great news. Obviously, we're going to need more public investment to increase the research and development jobs as well in our public sector from higher ed. But there's been some improvement. We're still about under 9,000 jobs in research and development compared to our closest neighbor over there, Oklahoma, about 14,000 jobs in research and development. So we have a long ways to catch up to them as well. And then this gives you another area where we could see more growth if there's a little more stability on our trade policy or a little more certainty on our trade policy. Last year was a hot mess, mostly for the trade policy. You can see towards the end of the year there, you see a spike in imports and a drop-off in exports for the state of Arkansas. The gray line is the sort of trade deficit for the state of Arkansas, if you were to think of it that way. We don't typically run a very large trade deficit here in the state of Arkansas. Our exports and imports are largely in balance. But the difference you see at the very end there, where imports shot up and exports dropped off a little, largely has to do with timing of purchases around the different tariff announcements that we saw in the news over the last year. Exports are an important industry for the state of Arkansas. We have well over 2,400 businesses that export in the state of Arkansas. We have 34,000 jobs directly linked to exports in the state of Arkansas. And the thing about exports is, if you're going to export to somebody else, you got to import what they're selling to. That's kind of how it's called a trade for a reason. So you kind of have to have both sides there. And then this gives you an idea of who we're exporting to. So our largest export partners, obviously, are Canada and Mexico under the USMCA, followed by Europe, and then Asia, and then the rest of the world. So we have about $1.5 billion worth of exports going from the central Arkansas economy. We have $1 billion worth of exports going from northwest Arkansas, about $500 million worth of exports going from Fort Smith. So it plays a huge role in these specific metro areas from a total of about $6.5 billion worth of exports. So this gives me an excuse to talk to you a little bit about how the rest of the world is going to do, especially our trading partners. So basically, I'm going to just touch upon the three largest trading partners that we have. But first, I'll give you a very quick forecast of what the overall international economy is going to look like. You can see fairly moderate growth over the next you have 26 and 27 there, fairly moderate growth across there. Now keep in mind that these forecasts are best guess using data, models, all kinds of tools, and then a hope that the future will behave itself, which lately the future has not been behaving itself at all. But the reasons for the positive forecast broadly internationally is because we've been able to weather so far the trade uncertainties. There's a lot of fiscal and monetary policy support coming from different governments, including ours. And we've had a lot of economic activity in the AI space that has not just benefited us here in the United States, but benefited other countries as well. All of those are basically the same downside risks for growth in the next few years as well. A lot of growth coming from just one sector in AI means that if there's any correction in that sector, it's going to reverberate not just in the US, but across the world as well. And then a lot of additional fiscal support propping up growth in the next year means that some of those bills are going to have to be paid, as we'll see here. So while the growth forecast looks fairly positive over the next few years for the rest of the world, it is still very precarious. The risks are definitely leaning towards the downside as opposed to the upside for the rest of the world. Some of this is, again, as I was telling you, some of the growth is supported by fiscal activity in some of these countries. For example, the big tax bill that passed last year in the US will add about 1% growth to the United States in 2026. Germany has passed a lot of stimulus measures as well. They'll add about 1% to their economy in 2026. Japan has instituted a series of, or plans to institute a series of tax cuts, has instituted some tax cuts in the last year. That will add about 0.5% to their economy in the next year. But all of this has raised the yields on government bonds, especially 10-year bonds, in the last several months. And so that's what this chart is showing you here. So there is some worry in the market about all of this additional fiscal impulse coming from all of these different countries. And then governments have responded to this by issuing shorter-term paper than they traditionally do. So instead of issuing long-dated bonds, 10, 20, 30 years, a lot more short-dated bonds are being issued because the yields on those tend to be a little bit lower. Sounds good in theory. You can reduce some of your debt burden by doing this, except now the fiscal policies are very directly linked to monetary policy because short-term rate changes from central banks will directly affect how much the fiscal balance of different countries going into the future. Nonetheless, we've had some uncertainty in the last year, quite a bit of uncertainty, as evidenced by how much people were interested in buying gold and silver. Gold has always been the metal that people run to in times of uncertainty, and you can see gold prices shot up remarkably in the last year. Silver is a new thing. I didn't expect people to be investing a lot of silver. I myself got into this game a little bit. I invested in silver hair in the last year. Certainly got a lot more of that. But the Razorbacks are very prescient. They invested in a whole field of silver in the last year. Really? That was the tamest joke I could do about the Razorbacks from last year. That's because you guys don't even remember the name of the coach we hired, isn't it? Shame on you. All right. So our biggest trading partners, Canada and Mexico, are seeing slower growth in 2025, slower growth in 26 and 27 as well. A few tough years ahead. We're their largest trading partner. We've become somewhat unreliable as a trading partner for both Canada and Mexico, so we expect to see their economy slow significantly. Canada has been trying to sign new trade deals with other countries to diversify away from the United States. The impacts of those are obviously going to be longer term than shorter term. One thing Canada could really do is improve trade between provinces in Canada. So while they don't have tariffs on each other between provinces, they do have very different regulatory environments between provinces. So it's very difficult for businesses to do business across Canada itself. And that should actually help them diversify away from the US a lot more than some of these trade deals. Mexico has done a lot to improve the overall quality of life in Mexico. So in the last 10 years, the poverty rate, they dropped the poverty rate by about 10% of the population, but a lot of their fiscal support policies are expensive, and some of those bills are coming home right now. They haven't made a lot of sales from the petroleum as well. So again, Mexico's growth very closely related to ours. Not seeing a whole lot of investment anymore because people are worried about what NAFTA or USMCA looks like in the next year. So again, on the left, you can see the chart here that compares Mexico to other emerging markets, and they have underperformed most of those markets. And the chart on the right gives you an idea of what's going on with USMCA as we reach a review of it this year. You can see that suddenly last year, a lot more products from Canada and Mexico got classified as being part of USMCA. So while the headline tariff on Canada is about 35% and the headline tariff on Mexico is about 25%, on average, they've been paying about 10% by classifying more of their products as being under USMCA. That only works till about July or June of this year when they have to review USMCA. So, whether or not they'll still be able to get away with this level of classification remains to be seen. But this has helped temper some of those tariffs for Canada and Mexico, but we don't expect this to continue in the upcoming years. The euro area, it's not a whole lot of growth in most of the major economies in the euro area across the board. Their economic model has largely been based on American protection, Chinese demand, and Russian energy. All of these things are no longer true, including a rules-based globalization. Again, that seems to be going away a bit as well. We do expect a little bit of growth in the future, largely because they're spending additional money to stimulate their economy in a way that they haven't done in the last decade. And this gives you an example of the largest economy in Europe, Germany, and how they've fared. So they were depending on a lot of trade with China. You can see that their exports to China have dropped off at the same time that their energy input costs have gone up. So that has affected Germany's economy as well. Their manufacturing is probably in the 8th year of crisis at this point. But Germany, along with other European countries, are investing in defense spending, partly because we've asked them to, partly because they want to, again, diversify some of their defense away from us. So you see a lot of increase in defense spending in the last couple of years. This is expected to stay in Europe. And so this should help stimulate the economy, even if they're going to have to be borrowing money to do this. The other thing that is expected to grow their economy a little bit is that consumer prices are down, so their inflation rate is lower than here in the United States, and their wage growth is higher than the rate of inflation as well, so we expect that growth to help them out a little bit. Nonetheless, as I pointed out earlier, they have the same fiscal challenges that we have, and then you can see here that, there was once upon a time when people thought Spain was really bad and how much debt they were carrying. And you can see here in the near future, Germany's deficit is going to increase. And then the AI boom has really helped Asia as much as it has helped us here in the United States as well. So the chart on the left shows you how much exports are coming out of Asia to other Asian countries and the US. That does not include China. And then the chart on the right shows you the same chart with China included, or just from China. So you can see that we're not getting a lot of those exports from China, but other Asian countries are seeing those exports. So Asia has been growing a lot more in spite of all the trade frictions from this AI boom. Again, as I pointed out earlier, being that dependent on one sector that has seen a lot of leverage and investment is a problem for Asia as much as it is a problem for us here in the US. And then this is my chart to offend all three countries involved here by calling them past, present, and future. Neither one, all of them probably want to be future, none of them want to be past, but I've set this up this way to kind of give you an idea of where growth is and where growth is likely to be from Asia in the near future. You can see Japan's growth rate expected to decline even with those additional stimulus measures that I mentioned. China's growth rate expected to decline as well. India is expected to remain the largest or fastest growing economy in the world over the next couple of years. And you can see that their growth rate is about 6, 7. Thank you. You're welcome. I will leave now. I'm sure you got tired of hearing that with your kids all last week. So now that I've ruined it, hopefully it goes away. But you can see the Japanese yen is a lot cheaper to us here in the US than it has been, along with the fact that you can get $800 tickets to Japan from XNA. Everybody and their brother has been in Japan trying to get this Instagram shot, but because the yen is so cheap and all of you get cheap tickets as well, this is a shot they've been getting instead. So good luck trying to get a really pretty picture of a really nice place. The Chinese economy survived most of last year by exporting, not to the US, so you can see that their exports to the US dropped off, but their exports to other Asian countries increased significantly. So that has helped their economy, but they still have long-term concerns for their economy. So their economy is aging. They have a demographic problem there. Their property sector is still in a slump. Their consumers are not spending as much money as they should, so they don't have a huge domestic economy. And they have oversupply in several sectors in their industries. So there's not a lot of places to sell their products, although they've done that in Asia in the last year. That we don't expect that to continue to remain true. So profit margins at some of their businesses are going to be lower, which means their workers are going to get less money, which means their consumer economy won't do as well. So that's why you see that growth rate declining in China. And then finally, we expect India to be the fastest growing country in the world in the next couple of years. Question here is whether India finally meets its potential. We've talked about India as a future, I don't know, for about 25 years at this point. It hasn't quite met the future yet, but you can see that they're trading less with us, more with China. You can see what they're trading. A lot of these products across the board, a lot of these come to the United States. But the biggest upside for India is obviously the demographic dividend. They have a lot of young people, and their incomes are going up. So this is a country of 1.4 billion people. If 20, 30 million people reach the global middle class each year, all of your companies suddenly have a huge customer base to deal with. So there are challenges, obviously. There are only 100 million people in the formal economy, over 50%, under 50% labor force participation rate, and a high youth unemployment rate. But nonetheless, they still have a lot of potential if they can work through some of these challenges. With that, I'm going to stop my terrible jokes here, not say anything else. I will remind you that you have cards in front of you. If you have questions, please put them on those cards. And thank you very much.
Thank you, Mervyn. Thanks for your insights. Well, I told you you're in for a treat today, and Mervyn had great insights, and there's more to come. So it's now my pleasure to introduce today's moderator, Matuska Lindo-Briggs. Matuska is Senior Vice President and Regional Executive of the Little Rock branch of the Federal Reserve Bank of St. Louis. In this role, she supports the bank's mission of promoting a healthy economy, financial stability, and community development by building durable, two-way partnerships with business and community leaders throughout our state. Matuska has held leadership roles at the St. Louis Fed in community development, public affairs, and supporting the bank's fiscal agent responsibilities for the U.S. Treasury. She's recognized for advancing economic equity and financial capability through strategic programs, partnerships, and leveraging her expertise as a skilled communicator. Please help me welcome Matuska Lindo-Briggs.
Good afternoon. So great to be here. I definitely want to say a huge thank you to Mervyn, Chancellor Robinson, and Dean Williams for having me at one of my favorite economic events, one that we're not planning anyway. So really happy to be here. It's always a pleasure to collaborate with Mervyn. I don't know if you all know, but he was in our Community Development Advisory Committee, so I get to work with him often. So again, thank you very much, and he is truly Fed family. So there's nothing that the Fed enjoys more than engaging in economic discussions, which is precisely what we have planned for you here today. But before I introduce President Musalem, I would like to provide an overview of the Fed's structure, its various voices, and how the information flows to inform our monetary policy. So this is really going to be a quick overview so that we're all in the same place when I set the table for him to come up here for a discussion. So before I get started, something that I have to tell you is everything that I'm saying here today, these are my words, my own words, not those of the Federal Reserve Bank of St. Louis or the Federal Reserve System. So really, our overseer for the Fed system is Congress. And I want you to take a look. We are decentralized by design. So if you look on the far left, the Board of Governors, that is an independent agency of the federal government. Those are our 7 governors, which includes Chair Powell. They're appointed by the president and confirmed by the Senate. Now, if you go all the way to the other side and look at the Federal Reserve banks, think of us as your operating arms. You know, you think of monetary policy, we have community development, supervision with our supervisors. So, and there's 12 of them with the 12 presidents. Where we meet in the middle of this decentralized system is the Federal Open Market Committee, which most of you know as FOMC. So that's where your voices, all the voices of Main Street, that's where they meet. All 7 governors and all 12 presidents, a total of 19, will share the voices of what you're saying. How does the information flow? How does it get to them? Don't you wonder how they make their decisions? And we're going to get into this a little bit more with Alberto when he comes up here. So we all know about the hard data, right? So we have the data, we have the research. There's a 6-week lag to that sometime. So to add to that, we have the qualitative information. And that's what we put together. What we're trying to do with this is get the real-time information, what's happening now, trying to get in front to understand consumer behavior in comparison to that data. And so together, they use that for the full economic picture to see the trends of what's happening. So I think when you hear Alberto today and you understand how they all talk, how they all communicate at that table, and how he shares all of the information that it hears from you, you'll see why it's so important. So the information comes from multiple channels. I'm going to start with our advisory groups because this is really what's most important. All 12 banks have directors. These directors helped us, and all 24 branches also have directors. We also have industry councils that come up to the St. Louis Fed and talk to us about what's happening at least 2 times a year. And it is an economic exchange because through all the 7 states that we cover all our part, we have representatives from all of them that come from these different industries to share what's going on. And then we have roundtables and just one-on-one. I know many of you, when I'm up here, I meet with you one-on-one. We have roundtables. It's really to try to understand what's happening. Next, we have surveys. If you have a chance to do a survey, they're quarterly, take about 5 to 7 minutes, and you have time to just share what's going on. So if you have a chance or if you want a chance, please reach out to us. We would love that, to hear what you have to say. Then we have just informal outreach, so it's not just me and the directors, our supervision people that are out there talking with bankers, our researchers. All of this is part of the engagement and how we're gathering that information to take it to our president, as well as just sometimes I might get a call, can you email, a manufacturer to understand what's happening. And lastly, it's that soft data, unstructured. We have many people here that send us reports, share the surveys that you have with us, and we appreciate getting that. So that's just, I wanted to give you a very high level to make sure that we were all on the same page when we were sitting down to talk. So with that, I would like to introduce Alberto Musalem, who is the president and CEO of the Federal Reserve Bank of St. Louis. In this role, he participates on the Federal Reserve's Federal Open Market Committee, or FOMC, which meets at least 8 times a year to set the direction of U.S. monetary policy. He also oversees the activities of the 8th Federal Reserve District at its St. Louis headquarters and branches in Little Rock, Louisville, Kentucky, and Memphis, Tennessee. As the St. Louis president, Musalem makes public outreach a priority, talking regularly with people and communities across the 8th District about the economy. Engaging the Main Street provides him with important insights as he represents the district at the monetary policy table. President Musalem has nearly 3 decades of experience in economic policy, finance, and markets. Prior to joining the St. Louis Fed, he served as CEO and co-chief investment officer of Events Asset Management. He was also executive vice president and senior advisor to the president at the Federal Reserve Bank of New York. In addition, he held several positions, including managing director, partner, and global head of research at Tudor Investment Corporation. Early in his career, he was an economist at the International Monetary Fund. Musalem earned a PhD in economics from the University of Pennsylvania. He also holds master's and bachelor's degrees in economics from the London School of Economics and Political Science. Alberto, come on up.
Thank you, Matushka. Good morning. It is my pleasure to join you here in Rogers for the 32nd Annual Arkansas Business Forecast Luncheon. For this kind invitation, I would like to thank the University of Arkansas Chancellor, Charles Robinson, Walton College of Business Dean Brent Williams, and the host of this event and Director of the Center of Business and Economic Research, Mervyn Jebrash. That was a really funny presentation, by the way. This is my 4th visit to Arkansas in the past year and a half, and I always learn a great deal about the dynamic state and economic conditions when I'm here. I look forward to taking questions from my St. Louis Fed colleague Matushka Lindo-Briggs in a few minutes, but first, I would like to offer some remarks on the economic outlook and monetary policy. Note that these are my personal views and are not necessarily shared by my FOMC colleagues. I will begin with a summary of my remarks and then elaborate on them. First, the U.S. economy has been resilient, with considerable momentum coming into 2026. I expect the economy will continue to grow at or above trend this year. Of course, nothing is certain, but I see tailwinds supporting economic growth. Second, the labor market has been cooling over the past 18 months in a gradual and orderly way. The unemployment rate has remained near the level that economists generally associate with the full employment, the so-called natural rate. While further cooling is possible, I believe the risk of substantial deterioration in labor market conditions has been lessening. Third, at 2.8%, price inflation exceeds the Fed's 2% target. Core inflation, which is a measure of underlying inflation that excludes food and energy prices, is also at 2.8%. Inflation has eased gradually in recent months, and I believe that the risk of higher inflation has diminished. As the effects of tariffs on inflation ebb, I expect inflation to resume a path towards our 2% target. However, I also perceive a meaningful risk that inflation could remain above 2% for longer than we would all like. That leads me to my fourth point on monetary policy. I supported the FOMC's decision earlier this week to maintain the policy rate, the federal funds rate, in the range of 3.5% to 3.75%. I believe that this setting is neutral in real inflation-adjusted terms, neither restrictive nor accommodative, and appropriate given my assessment of the baseline path for the economy and the balance of risks. With inflation above target and the risks to the outlook evenly balanced, I believe it would be unadvisable to lower the rate into accommodative territory at this time. I could support a lower policy rate if further signs of labor market weakness emerge, provided there are no signs of increasing persistence in above target inflation and that inflation expectations remain well anchored. I could also support lowering the nominal policy rate if expected inflation declines sustainably to 2% or below. I will now elaborate on all these points. Economic activity measured by inflation-adjusted or real GDP rose at 4.4 annual rate in the third quarter of 2025, more than twice the long-run average. Many tracking forecasts peg the fourth quarter real GDP at 2% or higher, and forecasters have been marking up their growth projections for 2026. I expect the economy will continue to expand at or above its long-run trend rate in 2026. Consumer spending was solid in October and November, and retailers reported a good holiday shopping season. Reports indicate that consumer spending was especially strong in late December and into January. A resilient labor market, income growth, and accumulated wealth effects have supported consumer spending. Analysis of household spending in recent months by St. Louis Fed staff finds little difference in real spending growth across cohorts grouped by spending levels. However, reports from credit card issuers and others indicate that credit and debit card spending growth was stronger among high-income consumer groups in 2025. Illustrating how wealth gains can affect discretionary spending, a CEO of a firm that sells recreational vehicles recently told me that he has observed his firm's sales are higher when the stock market rises, even on the same day. Consumer spending is also affected by inflation, and reducing inflation to target could help consumer demand by supporting real incomes. In conversations with business and community leaders and others, I am frequently reminded that inflation is continuing to erode the public's purchasing power and that the high cost of living is especially challenging for those of limited means. These conversations drive home the importance of finishing the job of restoring price stability. Several tailwinds support my baseline expectation that solid economic growth at or above its long-run trend in 2026. Supportive financial conditions are among those tailwinds. The buoyant stock market, historically tight credit spreads, and solid growth in bank lending and corporate debt issuance are all indicative of that support. Credit is widely available for households, firms, states, and local governments. Furthermore, beginning in September of 2024, the Federal Reserve lowered its policy rate by 170 basis points, that's 1.75%, moving the stance of monetary policy from restrictive to neutral. This easing has likely provided momentum to the economy. Changes in tax law and in various forms of deregulation could also lift spending in 2026. Estimates vary, but reductions in individual income tax rates and changes that incentivize firms to increase business capital expenditures enacted in 2025 are expected to boost growth this year. Growth in productivity is another potential tailwind. Both labor and total factor productivity have been recovering and on an upswing since early 2023, with a marked improvement in the second and third quarters of 2025. This is a very encouraging trend, and I'm hopeful that it will continue. I perceive three contributing factors or phases to the recovery in productivity. Initially, firms invested in traditional automation and other labor-saving technology in response to tight post-COVID labor markets and rapidly rising labor costs. Additional investments came later in response to rising material and other non-labor costs as inflation rose. More recently, firms have been deploying artificial intelligence, and many are reporting efficiency gains. St. Louis Fed economists have found evidence that AI is contributing to higher productivity for certain types of jobs and in particular sectors. Conceivably, these investments could result in lasting productivity gains that raise the economy's growth potential. However, it seems early to label the recent productivity recovery a renaissance. Productivity growth has been only modestly above historical averages, whether measured over the last 4, 8, or 12 quarters against the period from 1980 to now. While the recent upswing in productivity is a potential tailwind, the housing market has been weak for several quarters and poses some downside risks. The housing market is an important sector of the economy, so much so that economists have sometimes argued, quote, housing is the business cycle. Declines in mortgage rates and home prices sparked a modest increase in sales in the second half of 2025, and the decline in building permits for new single-family homes appears to have stabilized. Still, the housing market is not expected to be an engine of growth in the near term. The Fed's mandate from Congress is to focus on achieving maximum employment and price stability. Accordingly, we pay close attention to the labor market and inflation. Recent data indicate the labor market is regaining some of its footing. At 4.4%, the unemployment rate is at or near the natural rate that economists typically associate with a full employment labor market. It is also within the range of long-run unemployment rate projections of FOMC participants. At 50,000 jobs, the December increase in payrolls is within the range that St. Louis Fed staff and others estimate will keep the unemployment rate from rising. The 29,000 monthly average of new private sector jobs created between October and December is also within that range. However, job growth has been narrowly focused in one or two sectors, which is concerning, as are surveys indicating that the public has low job finding expectations. Still, job postings rose in December and layoff announcements declined. Initial claims for unemployment insurance also remain low, and continuing claims have fallen. Although hiring remains soft, continued above-trend economic growth should support demand for labor, while low levels of immigration limit growth in labor supply. Inflation has been stubborn. As I mentioned earlier, at 2.8%, both headline and core inflation remain above the Fed's 2% target. However, both rates moved lower in November on a 3-month annualized basis, reflecting subdued goods inflation and lower housing inflation. This is encouraging. But measures of services inflation that exclude housing have remained sticky at above 3%. Further, the absence of complete price information for October and the delayed November collection because of the government shutdown may have introduced some downward bias in reported inflation data. The recent paths of goods and housing inflation, along with lower oil and gasoline prices, have nevertheless increased my confidence that inflation is unlikely to accelerate in the near term. Rather, I expect inflation will resume a path towards 2% as tariff effects ebb later this year. Nonetheless, persistence in above-target inflation remains a risk. Business surveys report input and selling prices are continuing to rise in both goods and services, indicating inflation has some momentum. Surveys often cite tariffs as a source of high prices. Tariff effects on prices should be temporary, however, and I expect the effects from tariffs implemented in 2025 to wane in the coming months. But tariffs don't appear to be the only reason why inflation is running above target. St. Louis Fed staff estimate that through November, tariffs accounted for only half of the excess headline inflation above 2% and less than half the excess of core inflation above 2%. If inflation remains elevated as tariff effects wane, then other sources of inflation, potentially including monetary policy, will need to be considered. As I said at the outset, I supported the FOMC's decision this week to leave the policy rate unchanged. I also supported the committee's move last fall to lower the policy rate from restrictive to neutral as an appropriate response to downside risks to the labor market. Some risks remain, but recent signs of resilience and the tailwinds supporting economic activity suggest these risks have lessened. I believe that policy is now well positioned to respond as needed to either of the Fed's dual mandate objectives. I could support additional reductions in the policy rate if new evidence of labor market weakness or risks emerge, absent further signs of persistent above target inflation or rising inflation expectations. I could also support lowering the nominal policy rate if expected inflation declines to target or falls below it. However, given current data and the balance of risks, I believe it would be unadvisable to lower the rate into accommodative territory at this time. Aside from risking higher or more persistent inflation, easing could be counterproductive for the labor market by raising inflation expectations and long-term interest rates, and thus slowing the economy and hurting employment. Ultimately, a strong labor market and the economy depend on achieving and maintaining price stability. And my FOMC colleagues and I are firmly committed to achieving maximum employment and price stability for all Americans. Finally, to conclude, I would like to speak briefly about the important role that each of you plays in the work of the Federal Reserve. The economy affects everyone in the country, and therefore it is important that everyone has a voice. Federal Reserve banks, such as the St. Louis Fed, serve as that voice. Your experiences with the economy are critically important to the monetary policy decisions that we make. Your input helps us understand what's really going on in the economy and to avoid groupthink. That's why I appreciate the opportunity to meet with you today. When you hear people talking about the independence of the Fed, you should know that you were part of that. Your perspectives help us keep informed and make independent decisions on behalf of the American people. Thank you very much.
Come on over. Thank you so much for joining me this afternoon and talking, and I can share everything I'm thinking with everyone.
Okay.
Anyway, so many of you all, as you heard, he came here to make this event happen. He came straight from DC. So really, Alberto, I'd like to lean into that and that opportunity. And if you can tell us, what is it like at the table, and how do the participants work together?
So it's a very big table. There are a lot of people around it. There are 19 FOMC participants, and then there's a lot of staff that prepare and present to the committee. The 19 participants are 12 reserve banks and 7 board of or governors. And the 19 people are incredibly committed to the dual mandate of maximum employment and price stability, and all the discussions and all the information sharing and all the decisions always have that North Star. The meeting has 2 days. The first day is a level setting day where we each share with each other what our analysis of the economy is. The staff also presents what their analysis of the economy is. So we level set, we share information on what we're hearing, what our research teams are seeing in the data and the models that they run, our business outreach. We share that with each other, and we learn a lot from each other. I take copious notes. Everybody takes copious notes because we're in a learning process, we're in a level setting process. The second day, we come back after having absorbed all of that, and we actually make the policy rounds, and we each offer our views on what the appropriate policy is for the economy of the day. I think it's a fantastic contest of ideas. Everybody puts forth arguments, and more importantly than the arguments, it's the reasons for the arguments. And in the reasoning, you also learn. You think sometimes, well, I hadn't thought of that, and maybe I should look into that more with my staff and come back. And so it's also a learning process about what the appropriate policy is. So it's a very well articulated, deliberative process with a lot of information sharing and a lot of kind of best idea wins. It's about persuasion, and it is, in the end, about making the best policy we can for the economy and the American people at any point in time.
Thanks for giving us that inside view. When I travel around the state, I get a lot more candid questions now about the Fed. I think it's because we're in the news so much. And you mentioned it in your speech, too. I think one of the biggest questions is Fed independence. So I'd like to ask you, what does that mean for those of us here in Arkansas, or any state for that matter, and why is it important?
Sure. So we often hear about central bank independence, and really it is about monetary policy independence of the central bank. And what that means is the ability to conduct monetary policy without interference from politics. That we truly can, that our objective in monetary policy is truly the dual mandate, maximum employment and stable prices, and nothing else. So it's the ability to do that. It's really important because evidence suggests over many countries and over time that countries that have more independent monetary policy tend to have better outcomes for their populations. That means they have lower inflation, more stable inflation, more predictable inflation, higher employment, more stable employment, more predictable employment. So those are the outcomes. Now, monetary policy independence has to come with democratic accountability. And that's why it's important that we speak to the public, including in this event, but in many other fora. The chair of the Fed goes to Congress and testifies to Congress, that we explain ourselves, explain why we're doing things, what our reaction function is. And so that democratic accountability is really important. Something that's also worth saying is that there's a lot of independence built into the Federal Reserve System. And in that regard, the 12 reserve banks are a cornerstone of central bank independence, because each of the 12 reserve banks, St. Louis being only one of them, represents the people in their districts. This is a very large, complex economy, 30 trillion economy, 340 million people, and a very diverse economy. And so each of the reserve banks brings to the table their perspectives on their districts. And that helps us make decisions in a very balanced way, taking all the information at once.
Do you think Fed independence is at risk anytime soon?
From my perspective, there is a growing awareness by the public, by business leaders, and by elected officials of the value of central bank independence. And again, the value is that time and time again, we have seen across countries in time that more independent monetary policy making leads to better outcomes. And so folks are aware of that value in my understanding. And now is a particularly important time to have monetary policy independence, because I increasingly hear when I travel our district or when I read the news that people and businesses are concerned about rising costs, past costs that rose and potentially rising costs into the future, and challenge affordability. And also it's an important time to have monetary policy independence, because our inflation rate is running closer to 3% than to 2%. So we are committed, I am committed, my colleagues are committed to the dual mandate and bringing inflation back to target while keeping the labor market at its maximum employment level.
Earlier, I talked about all of the information that we get and that flow of information when we're going around talking to people in the districts. How does that feedback from our contacts, how does that help you? How does that input what you're deciding for FOMC?
So our district, just to put things into context, has about 50 million people in it. You can see, I think the map is still up on the screen, right?
Yeah, I think so.
So it's 7 states or parts of 7 states, very different industries, very different communities. So a lot of diversity of types of communities and industries. So I get out into the district a lot. That's what I'm doing here today. Matushka and her colleagues, the regional executives, are out in the district all the time. Our banking supervisors are out in the district all the time interacting with banks. We have regional economists that are out in the district all the time. We have community development teams that are out in the district all the time. And so we're always bringing that information back. And what I have found in this job, I've been in the job nearly 2 years now, is that the more grounded you are into what's really happening to the economy, the better you are able to contribute to policymaking at the policy table. And a reason for that is often, not always, but often what you hear in conversations. So I typically say nothing beats a conversation. You know, we do a lot of very fancy modeling and statistics and econometrics, and we do all that. And we look at that, of course. But nothing beats a conversation. The reason being that what you hear in conversations often tends to show up in the real data 3 to 6 months later. So by being out in the districts, you can bring that lead time into the policymaking.
Okay, I want to expand on that a little bit. We have bankers in the room, academia in the room, manufacturing companies, retail companies. So how do you assess the impact of inflation on these various sectors in the economy?
In 3 ways, not just inflation, but all the data we collect. We do it in 3 ways. One is in conversation. You know, I've been here in Northwest Arkansas since yesterday. I've been speaking to business leaders in the last 2 days, and I do that across our entire district. So one is in conversation. And I often ask, tell me about your pricing policy, tell me about your cost structure, tell me about your input and output costs, how you're thinking about it going forward. And so conversation is one way. The other way is we and all the other reserve banks conduct surveys. So we send out surveys, you know, every month, every 3 months, and we collect a lot of survey information. And lastly, we look at official data releases all the time. We put all that together, and we form a view on inflation.
Okay, we talked a lot about being on the ground and getting the information. Let's zoom out a little bit and think about, you know, truly at the end of the day for the Fed, we have 2 core responsibilities, right? Maximum employment and stable prices. So how do you balance that dual mandate?
Okay. So those 2 things sometimes are in conflict and sometimes they're not. When they're not in conflict, you really don't have to balance them because you can achieve both at the same time. So let me explain what I mean. If inflation is high, above target, and the labor market is really hot, and the economy is really hot, well, then we're missing on the inflation side, and the economy is too hot, and then what we have to do is we have to cool the economy so that inflation can come down. So no conflict there. In the opposite case, if inflation is below target and the labor market is very weak, there's no conflict there either. It's very easy at that point. What you need to do is stimulate the economy to bring inflation back up to target and the labor market to maximum employment. The challenging part where we have to balance things or trade off is when inflation is above target and the labor market is weak. And that's the situation we've been in for the past year. And what you do there is you have to, because you have 2 targets, but you only have 1 instrument, which is interest rates, you have to balance the interest rates to try and achieve both targets. And the way to do that is to consider 3 things. The how much you're missing on each target, what the expected time to bring each target, each variable back to target, and also the probabilities of doing so. So it's that kind of calculus. And let me say that balancing act is possible only if inflation expectations remain well behaved, remain anchored around levels consistent with our 2% target. If inflation expectations become unanchored and rise above that 2% target, then it's harder to balance that. And at that point, you need to focus more on the price stability part of the mandate. That's not what's happening now. Inflation expectations are consistently anchored at levels consistent with our 2% target.
No, I think that's a great explanation, a really great way for us to understand that. I want to talk a little bit about jobs, especially AI and automation, because you and I were both out yesterday, and that's kind of been what everybody's looking at. There's concern on it. There's excitement about it. Mervyn even talked a little bit about it. But will advances in AI and automation, would you say, lead to sustained growth in productivity and employment in the United States? Productivity
is one of the most important variables in economics, and here's why. If if you take two countries, one with high productivity, one with low productivity, the well-being, the standard of living of the country with high productivity will 10 years later be much higher than the country with low productivity. So that's a very important variable. We've been, as I said when I was delivering the speech, the productivity has been recovering. It's still not very high, it's kind of average, but it's been recovering, and it's been recovering for three reasons. AI is the last reason, but it's been recovering because after COVID, companies felt that labor costs were really high. There was a lot of hiring after COVID, wages rose, and companies felt that they had to engage in automation, other labor-saving technology to do more with less, or cut costs. And after that, you had the inflation rose and non-labor costs rose, and then they had to continue to do traditional productivity enhancing to contain non-labor costs. And then the third wave has been AI. We've done some work at the St. Louis Fed. It's available on our website for anyone who's interested. Just search for it in the blogs. And our economists have calculated that if you look at different occupations across different industries, you can see that occupations that use AI more are much more productive. So very meaningful productivity increases. That's at a micro level, within firms, across sectors. At a macro level, we may be seeing some effects from productivity, but I think it's from AI, but I think it's early to tell. Companies are reporting benefits. Every company, every conversation is about experimentation with AI, and of course you hear situations where AI is really enhancing productivity, coding, for example, customer service, risk management, fraud detection, but we're still not seeing it in the macro data.
Okay.
Yeah.
I mentioned we have a lot of bankers in the audience. What are district bankers telling you about economic conditions?
Bankers tell me that the economy is fine, is solid, that loan pipeline is strong, that credit quality is generally strong, that there are some pockets of weakness in delinquencies in credit cards and in auto loans. They tell me that in the last quarter or so, they felt a higher competition for deposits or for the funding side of the balance sheet, and that could be constraining some banks in terms of their loan growth, in which case they might have to accept lower net interest margins. But bankers generally are pretty optimistic, I would say.
Okay. How about the district as a whole? When you look at it, what's the economic outlook for the 8th district, and what factors play a crucial role?
Generally, when I talk to companies and others, the outlook is one of cautious optimism. There are different sectors, different views. The more optimistic sectors tend to be large retailers, bankers, and manufacturers. The less optimistic sectors tend to be agriculture, transportation, and healthcare. Companies generally report a pretty resilient consumer. They report a labor market which is no longer hot, where it's easier to fill vacancies, where wage growth has returned back to a normal level of around 3.5% per year. Companies report cost pressures, and they report cost pressures on raw material costs, and that's normally associated with tariffs in the conversations that I have. They also report higher costs coming from insurance and healthcare costs. So things that have nothing to do with tariffs are also pressuring costs. Companies that are further away from the consumer, so up the supply chain, tend to pass on those costs more efficiently to their downstream customers. Companies that are closer to the consumer, selling to the final consumer, are having difficulty passing on those higher costs. And as we just talked about a minute ago, all companies are trying to find productivity gains to contain these higher costs with automation, AI, just doing things better.
I'd have to agree with you. I think when I'm out, I hear a lot about the insurance costs, but also the utility costs too. That's really something that we've been hearing a lot. So outside of your role with the FOMC, what is the biggest priority you have for the St. Louis Fed?
Okay, so people think of the Fed as we set interest rates and that's it. But we do many other things. And Matushka, I think, said it at the beginning. You know, our staffs and the reserve banks, through delegated authority from the Board of Governors, supervise the banks, and many of your bankers, you will know that. You know, so the assets of the banks that we supervise are something like $30 trillion. So it's a lot of what we do at the reserve banks. Staff in the reserve banks also operate the payment system. So when somebody writes a check or pays in cash or sends a wire or uses our instant payments FedNow, you know, that's moving $5 trillion through the economy every day. So that's another responsibility that, you know, as a St. Louis Fed president, I'm focused on for my bank and for the system. We have teams that do consumer protection and community development. And we also serve, some reserve banks serve as fiscal agent to the U.S. Treasury, meaning the banker to the U.S. Treasury. So I'm focused on making sure we do our monetary policy responsibilities right, and we do all these other responsibilities right on behalf of the American people. And to do all those responsibilities to the best of our abilities, my priority is to make sure that we are a very accessible bank to the people we serve, to make sure that we're constantly in contact along all those business lines with the folks that we are serving.
All right, I'm going to ask you one last question, and then we're going to have Mervyn come up here and give a chance for audience questions that you wrote. But you mentioned it in your speech. You started in April of 2024. You've been to Arkansas 4 times, and 2 of those times you've been to Northwest Arkansas. I'd love for you to share with the audience here, since we're here, some of your biggest takeaways that you could share with us.
It's a really simple takeaway, and it's been not just about Arkansas, but all the 7 states, but mostly Arkansas, and particularly Northwest Arkansas. You know, I come here and I learn not just about the local economics or the state economics. I learn about the regional economics. I learn about the national economy, and I learn about the world, because of the broad reach that companies in this part of the state have. So for me, it's a very productive, trip, because I come away with a lot of insights that help me in my job.
And then you have fun being with me too, right?
Okay, that too.
All right, Mervyn, you want to join us?
Yeah.
So these are questions the people, okay, in the audience, okay. No particular order, right? Okay.
Order of legibility.
Right? Okay. How close, and Alberto, I think this one would be for you. How close are we to meeting the Fed's 2% inflation target?
It's a great question. Right now, we're closer to 3 than to 2. We're running around 2.8. My expectation is that some part of that, maybe half of the distance between 2 and 2.8, about half that distance, in my estimation, is tariffs. So I expect that half of that distance to go away as the year progresses. So by the end of the year, I think we will be closer to 2.4, 2.5 in inflation. So still far away from our target. And then I think we will consolidate the move towards 2 into 2027.
Okay. I think both of you could speak to this. What are the key economic indicators we should be monitoring to gauge the health of the banking sector? And you talked a little bit about it too. Mervyn, do you want to start?
Yeah, one thing that I've seen other communities, so Northwest Arkansas is sort of immune from this, is the loan portfolio on the commercial side. Obviously, Northwest Arkansas's office vacancy rate is incredibly low. That's because we've invested in office more recently than other markets. But Central Arkansas, for example, has a vacancy rate in the mid-teens. And I think there's been some concern over a longer period of time about when some of those commercial loans come to be mature and which banks' balance sheets they're sitting on. They tend to be concentrated in the small and mid-sized banks. So again, I'm looking at commercial vacancy rates on the office sector in particular, and wondering if we'll ever see something on that front. But broadly, on the consumer side, I don't see a lot of bankruptcies. Definitely the mortgage side is doing incredibly well as well.
I look at credit quality of the different credit portfolios. I look at capital that can absorb losses. I look at liquidity. I look at governance of the banks to make sure that they're well governed, well managed. And I look at best practices and control environments. That's what I look at.
All right, Alberto, how does the Federal Reserve support small businesses and entrepreneurship in the Arkansas region?
So the two ways. The best thing we can do is make sure the national economy is stable. Make sure that inflation is back at target, the labor market is at full employment, because if it is at full employment, it means the economy is performing well. So the best thing we can do for any region in the country is making sure the national economy is doing well. Another way in which we do it is making sure the banking system is healthy and lending and helping small businesses finance that growth. And also we do a lot of economic education for folks that may run small businesses about the economy, about finance, about the Fed, about just being well educated about the context in which they're operating.
Mm-hmm. I'm glad you brought that up too. Those resources are available online. They're also free and can be printed. Okay, this is a good one, and I want both of you. I'll start with you, Alberto, and then I'd love to hear Mervin's thoughts. What are your thoughts on the new Fed chair nominee? From the audience.
So I've known Kevin Warsh for about 16 years now. He's exceptionally qualified for the position. I look forward to working with him once he is confirmed by the Senate. I look forward to learning more about his policy priorities and his vision for the Fed, and to welcoming him once he's confirmed. Until then, I'm committed to continuing to work with Chair Powell to deliver the dual mandate for American people.
Okay.
Yeah, I mean, I think he's a very eminently qualified Fed governor. I think he was one of the youngest in his previous appointment to the Fed. And so I guess my only question would be looking forward to his chair term, at least in his last go-around on the board. He was a little more of an inflation hawk. And so I'd be curious to know where that is, because I don't think that was the current policy preference of the administration. But again, as you mentioned, the inflation is still pretty high, so that is something we need to pay attention to.
Right. I'm going to put this other question. It's similar to that one, so if we have time, I'll come back to that one. What are the primary factors contributing to housing affordability concerns in our region, and what potential solutions could address the challenges? I'll ask that to you, Mervin.
Well, I talked about one of them is one, we need to work on a water sewer infrastructure for our region, because we've underinvested in that as a region for a long period of time. The other piece is that while the mortgage rate is what it is, it's likely never going to be 3% again, and we are trying to improve the supply of housing, it is likely that the market itself will never build subsidized or affordable housing. If you're thinking of sub $200,000 homes, that's unlikely to happen from the market at this point. So then we need to ask some questions about whether the public sector here in Northwest Arkansas, through some existing tools that we already have, bonding authority at our different cities, should be getting in on financing mixed-use developments, mixed income developments, so you are building additional housing, but you're able to provide units at a much lower rate than the market can by itself. So I think that's an interesting place that we need to consider in the future. So by that, I mean the next few years. First, we got to build that water and sewer infrastructure. So that's the first part.
Okay. Do you want to add to that, or
no,
we can move on? What opportunities do you see for economic growth and development in Arkansas and our region? You touched on that a little bit, Mervin, too.
I'll say the drivers of economic growth, the long-term drivers, are population growth and productivity. And the driver of productivity, the deep driver of productivity, is education and opportunity. So a lot of the growth, according to your presentation, Martin, was population inbound migration, and that's an important driver. But you also want to make sure that for the population that is kind of the incumbent population, that there are educational opportunities so that young folks can come into the workforce and be very productive members of the workforce that can meet the challenges, technological challenges of the needs of a new economy.
Mm-hmm. Did you want to add?
Yeah, and we toured the music facility yesterday where we're working on silicon carbide research. So there is, we're working on, obviously the university is educating a lot of 35,000 students. We're also working on the future technology of what could be in our cars and the electricity grid, et cetera. So that could be an important avenue as well for the state.
Yeah, that music facility was absolutely fantastic. That was amazing. I'm going to do 2 more questions here. Has there been any discussion about or support for changing the very arbitrary 2% inflation rate target?
Okay. My colleagues and I are committed to a 2% inflation target. So there's no discussion of changing it. Now, let me just leave it there.
Okay. Okay, I'm trying to read this one, you guys. I think I have the harder job here. On the labor side, how confident are you in reliability of data and data sources?
Yeah. I think I hear constantly when I do presentations about how reliable the federal data is. The federal data, compared to every other country that produces data about the state of the economy, our country's data is the gold standard. The challenges that we have with the data, though, is that Bureau of Labor Statistics, Bureau of Economic Analysis, Census Bureau, all of these different organizations that collect data have been underfunded for decades at this point. So it has become incredibly hard for them to collect timely and accurate data. So the problem isn't political bias or anything else like that. It's that we're not funding them enough to produce. We ask them to produce all of these different data sets, but we don't give them enough money to go out and collect this on a timely basis. And then the rest of you don't pick up your phones when they call you to survey you. So you're making it incredibly hard.
Okay, this last question is a little more local based, so I'll probably send it to you, Mervyn, and if you want to add in a different way, Alberto, you can. So how do current economic conditions in Arkansas compare to the national trends?
Yeah, we've traditionally done a lot better than the country as a whole, but as I showed you in that unemployment chart, we're starting to get a lot closer to the national trends. So our labor market here in Northwest Arkansas was running a little hotter in the last year, but the state as a whole definitely cooled in 2025 compared to 2024. So we're sort of meeting that national trend in that respective. But I think broadly, we still continue to expect growth in the next year, in the upcoming year.
All right. Anything that you all would like to add, any words of wisdom as we end?
This is a great event.
Yeah, it is a great event. All right.
Thank you for coming.
Yes, Mervyn, I'll let you close it out if you want, or,
Yeah.
I didn't know you were going to come back up. Perfect.
Well, Alberto and Matuska, thank you for spending your afternoon with us in Northwest Arkansas. Let's give them a hand. To both of you, as a small token of our appreciation, we've got scholarships for 2 different students to attend the National Association of Business Economics Conference in your honor. So it'll be impacting 2 Walton College students. So thank you for your time today. Mervyn, I also owe you a word of thanks. Thank you for all of your insights on both the local and the broader economy. An event like this with 1,000, 1,100 people certainly doesn't put itself on, and there are dozens of Walton College staff that have made this possible today. Would you mind giving them a hand for their effort and work? So don't forget, fill out your evaluations for us so that we can make the Business Forecast Luncheon even better. And you can leave those forms as well as your forecasts on the table. Please leave your name badges if you will. Thank you for spending your afternoon with us. Look forward to seeing you at the next Arkansas Business Forecast Luncheon.